Okay, good afternoon. I hope everyone's doing good as we continue to fight through the coronavirus. Beautiful spring weather we're having, and I wish everyone very well. I'm excited for the lecture and the presentation this afternoon because it's on mutual funds. I think you know how I feel about mutual funds, so if you'll open to chapter 16. I do want to review a couple things in general about how the class is going. This weekend, I decided to send everyone who was behind in any assignments an email. And so all of you should have gotten an email, and I've actually had a lot of responses telling you what assignments you lack. Now, I didn't include the term paper and book report. They're not due till the end of the semester, and same with the three magazine articles. So but I did send you an email, and I'm going to continue to do this each weekend because I want everyone to get your 5-point assignments. And by the way, your assignment tonight, or for this lecture, I'll give at the end of the class. But I wanted to go over just a couple items that we've talked about, some of the responses I got to the emails. First of all, obviously, we're doing our budget. That was one of your assignments last week, was to do your budget, or not to do your budget, but just let me know how it was going. The responses were wonderful. They were positive. I think everyone's excited. A couple of you mentioned, just kind of like Robert and Karen Young, that actually you've got extra money now in spite of the coronavirus, uh, especially if you're working, because we just, quite frankly, can't go out and spend as much. This is a great opportunity, and I would just encourage all of you that if you, as you have more discretionary income, there's two ways really to put it to good use. Number one is to save, and number two is to pay down debt, especially credit card debt. So, good opportunity for all of us maybe to build up savings a little bit and reduce our debt. The investment assignment, I think, is going good. Hopefully, all of you are checking your 10 stocks every week to chart them and see how they do. I would also mention in about 3 weeks, your term paper and book report will be due. Obviously, no oral presentation. You can just email those to me, 4 or 5 written pages on how it went, and you'll get full credit. I hope, again, everyone has enjoyed that and gotten a lot out of it. There's still a handful of you that have not watched the Susie Orman DVD. Those that have, I think, have really enjoyed it. It was the 9 points of financial freedom. It's an excellent DVD. Susie Orman really knows what she's talking about. So please watch that. And then we'll go over that in a couple weeks. And the items that I go over during this lecture in 2 weeks will be on your second exam. But I think Susie does a great job. It'll be a lot like the Dave Ramsey. There were 4 or 5 questions on the first exam from the Dave Ramsey presentation. So watch for the weekly email each weekend, and please take care of that so you get all your 5 points that's coming to you. Now, we're going to talk this evening, or I guess whenever you watch this, about mutual funds. And I think all of you know how I feel about mutual funds. Mutual funds is the way that all of us can access the stock market without investing a lot of money, and it doesn't take a lot of expertise. It just takes a commitment. And once we do it, as I said, I've never met anyone yet that said, I'm through investing. I'm making too much money. Now, I realize during these times of the coronavirus, with some of the gyrations and ups and downs in the stock market, some of us might be losing money. That's why it's interesting to do your investment assignment and follow these 10 stocks, for 5 weeks. But as you look at investing in mutual funds on 560 and 561, if you'll open your textbook, first of all, the mutual fund is defined as pooling a lot of money by thousands of investors into many different stocks. And the 2 advantages on the next page of a mutual fund, number 1 is diversification, and number 2 is professional management. Let's just comment again on diversification, which was one of your assignments last week, and all of you did really good on that. If there's anything, and I'll just repeat what I said last week, that shows how important it is to diversify, it's what we're going through right now. A good example would be the airline industry. You know, I just heard today that a year ago, yesterday, on Easter Sunday, there were approximately 2.4 million people who flew here in the United States. Yesterday, Easter Sunday, a year later, 2020, with the coronavirus upon us, only 95,000 people flew. So obviously, the airlines are in trouble, and they're part of the stimulus package that was passed by Congress a couple of weeks ago. But that shows why you just never know what direction life will take us and the economy will go, and why we have to diversify. I mean, 6 months ago, the airlines were doing just great. They looked like a great investment, and they were. They probably still are. They'll come back, but it's going to take a little bit of time. Another example, too, are the oil companies. The price of oil is really low. Saturday, I gassed up in West Jordan for $1.95, one of our vehicles. I couldn't believe it. I had not seen gas that low in quite a while. And part of it is we're just not driving as much as we are hopefully heeding the advice we have and trying to stay home as much as possible and social distance. But this is just an example of why diversification is so important. Now again, the book mentions, in italics, be warned, even the best portfolio managers can make a mistake. And I guess my thought to you on this is not that they make mistakes, but there is risk whenever you invest. So when you invest in the stock market, through mutual funds or any other way, there's always risk. We already mentioned what risk-free investments are. Now, on Exhibit 16.1 on page 562 is interesting. It's just a small portion of what we call a prospectus or a portfolio. Again, this is for a fund called the Invesco Growth and Income Fund. It was from August 2018, a couple of years ago. But it just shows the way that they invest the money that they have, or the money that we may put in. And you can see there's a round circle, a pie chart at the top, and it shows the different sectors that they put money into. Some is just into cash, some is consumer discretionary, staples, energy, financials, healthcare, so on and so forth. Below you can see some of the companies that they put money in and the percent of total assets. You can see that there's not a huge percentage in any one, so you get great diversification. But you can see Citibank, Bank of America, JP Morgan Chase, Johnson & Johnson, CVS, Morgan Stanley, Citizens Financial, Devon Energy. So you can see there's a great amount of diversification in mutual funds. And again, the nice thing is you have professional management, you have people who are trained in this, and they really know what they're doing. Now, they're not perfect. They do the best they can. They look at all the data. They look at the metrics. They look at at all the things that to make a good decision. Sometimes it works out, some not quite so good, and we'll talk more about that. Now, let's turn over to page 563 and talk about some of the different type mutual funds. Now, I would just remind you that I had said originally that if you open up a mutual fund during the semester, I'd give you 20 points. With the coronavirus and some of the challenges that we're having, as you know, if you go into Canvas, everyone got that 20 points. But I still would love to see all of you open up sometime in the not too distant future a mutual fund. Now this again is over and above your 401k, which generally is already invested into a mutual fund or many mutual funds, but this is separate investing. So let's talk on 563 about some of the types of mutual funds where we can put our money. One is called a closed-end fund. That's a fund whose shares are issued by the company. It's closed in. There's not that many of those. Most are what's known as an open end. But a closed-end mutual fund is pretty tightly controlled, and the only time there are shares available is when someone sells theirs. Most are the exchange-traded funds or open-end funds, and they'll sell as many shares as people want to buy. Now, you'll notice in the middle of 563 that there's different types of funds. within a mutual fund, depending on where you want to put your money. And generally, when you open a mutual fund, you'll talk to someone. We talked about how we might be risk averse. We might want to take more risk. We might want to put 5 or 10% in a more risky type fund. And again, we know that diversification reduces risk. But you'll notice some of the different types. There's some that will just invest in what we call index funds, like the Dow Jones Industrials, the Standard & Poor's 500, the NASDAQ 100. There's some that will just go into mid-cap stocks. You'll see in the middle of 563 what's known as small cap stocks. These are smaller companies, fixed income, so on and so forth. Some will even just go into commodities. So there's a lot of different varieties. On page 564, you'll notice that there's the open end, which is the majority of mutual funds. They sell as many shares as people are willing to buy. One of the things that you'll take a look at, or should look at, when you're buying a mutual fund is to find out what the price per share is, and that's generally the value of the fund. That is the total assets minus liabilities over the shares outstanding. And again, one of the important elements, as I've mentioned in this class, not a math class, shouldn't have any mathematical problems, but what is important is what we call trend analysis. You can see in this particular one, the value of this is called New American Frontiers, is $21.67 per share. What I would be interested is to see what the share price has done over the last 3 to 5 years. Okay? Now, there are different type funds in that you have to realize that obviously the people that run these mutual funds work for free, just like the rest of us, so they get paid. And so there's what's known as load funds and no load funds. A load fund is where you have to pay a certain percentage back to the fund. In essence, you're paying for the expertise. A no-load fund is a mutual fund where there is no sales charge on it. Now, it almost sounds like, well, why would I get a load fund when I can get a no-load fund? Well, what you need to really do is take a look at the different funds, look at their performance on a trend analysis over 3, 5, maybe even 7 years. If it is a load fund, you'll take out the percentage that you're paying, maybe 0.5%, 0.75%, and then see how well it does. Generally speaking, my experience is this: the more the load is, and where there's a load fund where you have good expertise from management, generally I have done better. But it's something to definitely take a look at. Okay. There are, on page 566, there are some other management fees and other charges. One in particular is called the 12B-1 fee, which is on page 566. This is a fee that the investment company charges to defray their costs. And then again, this goes the cost of running the company, which would include obviously the compensation for the people that work there. The 12B-1 fee can vary from fund to fund, so you need to take a look at it and see exactly what you've got. If you look at Exhibit 16.2 at the top of page 567, you'll see, and this is called Davis New York Venture. Like I say, there are just literally thousands and thousands of mutual funds, but you'll notice for Class A shares, there is a load of 4.75%, so that's fairly high. Class B shares, there's no maximum, but there is a maximum deferred charge. So the bottom line is that you want to see what the total charges are, because if you're looking at the performance of a mutual fund over time, you want to see how much they're taking out so that you can properly evaluate that. And basically, when you add all those fees, it's what's known as an expense ratio on 567. Those are the different management fees, and you always need to either ask, or they should be in the prospectus that you might get. But obviously, it just makes sense that the people that run the mutual fund have to charge us some money. But overall, and I've been studying this for a long time, I can promise you, if you'll leave it in long term, remember our investment goal is long term. What's long term? The balance of our life, the rest of our lives. Not that we can't take some money out from time to time when we reach appropriate goals. But even with that, even with the expense ratios, the expense funds, mutual funds have far, and the stock market has far outperformed anything else. Okay, 569, different types of mutual funds. The ones that I like the most, especially for all of you in this class, younger, you got many, many years to invest and be in the stock market, are stock funds. The mutual fund, again, is how you can access the stock market at a young age with relatively small amounts of money, say $50 a month. It might cost you $100 to open it up. Again, the best thing is to get one that's automatically taken out of your bank account, checking account, however you want to call it. And then again, I've always found if I know X number of dollars is coming out of my account on the 20th of the month, which is the way I have it set up now, guess what? I always have money in there. But there's a lot of different stock funds, and you'll notice on 569, there's aggressive growth funds, there's equity income funds, there's global stock funds, the companies that might be doing work overseas. There's growth funds, and there's index funds that are tied in exactly just with leading companies in just one index, the New York Stock Exchange, or the Dow Jones Industrial, the S&P 500, or the NASDAQ 100. So we're not going to go through all these. If you turn over on 570, there's international funds, large cap funds, mid cap, regional type funds. We're not going to go through all those except to say there are a lot of choices. And to me, as you contemplate and open up a mutual fund, wherever it may be, and I gave you a handout, and there's going to be some more in the book of places that you can contact and open up these. I would just say, what are some of your stock funds and how have they performed over the last few years, and what do you recommend? And I think it's always good to spread your money in probably 7, 8 to 10 different mutual funds, and then ask how they've performed over time. Obviously look at the fees that go with it, and then make your choice. But I think at a young age, the best thing you can do is get into the stock market. Again, over the last 120 years, the stock market has been going since the late 1870s, I think, when it first started, when Mr. Dow and Mr. Jones, hand wrote down their average of stocks each day and started the Dow Jones Industrials. Nothing has outperformed the stock market. Now, there are different funds, and when you talk to an advisor, they may, push you in this direction. There's bond funds. We talked last week about bonds. Bonds are long-term debts. Generally, we're probably not going to buy too many bonds other than maybe U.S. savings bonds, which are smaller amount. There's no risk, very little return there, more for maybe gifts to our children or grandchildren. But if we really felt that the bond market was going to do good, we can actually access what's known as a bond fund, and that will be a mutual fund that just buys bonds. So we get the benefit of bonds without having to put all the money up front and leave them in for a long time period. And there's different type bond funds, high yield. Now let's think about this again. We'll reiterate this element. It's obviously going to be a test question in 3 or 4 weeks when we have our second exam. If it's a high risk bond fund, it's going to yield higher yield. Potentially. Once again, the greater the risk, the greater the yield. The greater the yield, the greater the risk we have to take. So again, we wouldn't put all our eggs in that basket. There's intermediate corporate bonds, there's intermediate bond funds, long-term corporate funds. Bond funds would invest in the big companies like GE, Walmart, Disney, some of the ones that we've talked about. Municipal bond funds. We talked about municipal bond funds that are states, cities, counties that invest in schools, roads, other public works like that. Let's remember, though, that only U.S. savings bonds are completely 100% safe. Municipal bond funds, we mentioned a couple last week, Orange County, New York City, Birmingham, Alabama. These are public entities that declared bankruptcy and the bondholders lost a lot of money. So again, diversification. We want to diversify, but we may have an advisor who has done some research and thinks we ought to put some money in bond funds. No reason why we shouldn't. There are some other funds that are mentioned on page 571. They're asset allocation funds, more balanced. I won't go into all these. There are so many different funds to put our money. That's why I think it's good to get a good advisor. So when you decide to open a mutual fund, whether it's with Merrill Lynch, A.G. Edwards, or venture fund, whoever you choose, I would ask to speak to an advisor and just say, I need some advice. I'm opening this up. I want to have diversification. This is my age. This is my income. This is some of the goals I have. My goal is a down payment on a home, a vacation, a second home, whatever the case may be. And you'll be able to tailor a program which will meet your needs. But there are so many to choose from. In some ways, that's great. In some ways, it's not as good because it's almost, you can be overwhelmed. Again, if you go in and Google mutual funds, you'll literally have 2 or 3 million choices, and nobody's going to go through all that. That's why I think if you go through some of the big companies, very well known, that I gave you in your handout that all of you should have, I think if you go in the direction of one of those, you'll be fine. And again, I always give my disclaimer. I don't work. I mean, I do invest and I do work, but I don't work for any of these particular companies, so I don't care what direction you go. I just want you to invest because I know the benefits that will come to you if you'll move in that direction. Okay? It's easy to buy and sell mutual funds. You just have to open one up, go into the website. You can do it for a relatively low amount of money, and then just start investing. When you do want to pull money out, one of the advantages of investing in a mutual fund, just like the stock market, as we mentioned, it's very liquid. Generally, if you're going to pull some money out, you've reached a goal, a down payment for a home or whatever it may be, you generally can get it out in 72 hours, which is 3 working days. So there is a good how-to on page 573, which is how to open an investment account and start investing. I won't go through all these steps, but I would refer you to this particular diagram on that page. It talks about a lot that we've gone over: setting your goals, how much you want to invest, there are as many programs as there are people. So I would just really, really encourage you to take a look at that. Now, if you turn over to page 574, there is a company called Morningstar. Morningstar does star ratings, and they rate mutual funds. You can go into their website and take a look, and you can see some of the better mutual funds that they feel are good. And that is fine. I would advise you also, or direct you to Exhibit 16.4 on page 574. Now, I gave you the handout that had, I think, 6 different mutual funds, and I gave you the name of the fund and the website that you can go into. Here are 3 other ones that are in the book, and they're all excellent. You can see that they're huge as far as the total assets they have. One is Vanguard, one's Fidelity Investments, and one's known as American Funds / Capital Group. You've got the website there, and you can see that all of them have well over $1 trillion in total money that they're managing. That means they have great diversification. It also means that they've had a good track record, or people would not continue to invest in that particular mutual fund. And it does give a little bit of basic information about these three funds. And again, I don't care what direction you go, I just want you to start doing it. The Vanguard Fund is kind of a low cost investment, has 400 different funds. When I say low cost, they don't give quite as much advice and their fees are lower. Fidelity Investments is a funded supermarket, if you will. Investors have access to over 10,000 different funds. Wow, that is great. That is why you want to get some advice when you talk to them, because you're going to sit down and evaluate 10,000 funds, especially when you're starting. American Funds Capital Group I like, and I have some money there, and it says it believes in the value of professional advice. They're sold through account executives. They charge a little higher fee, but as you start out over time, at least this is me, this is Robert Young speaking, over my lifetime that I've been investing, I have done best when I've had a professional manager to give me some advice. So we mentioned last week that there are some discount brokerages. This is more for common stocks. Charles Schwab is an example. You can go online to some of the other ones, but sometimes there's an old saying, you get what you pay for. So just some thoughts as you go forward. As I mentioned, there are professional advising services. Morningstar is probably the biggest one. As you think about getting into mutual funds. As you go into a mutual fund, there's a prospectus that we talked about. The prospectus, which they'll send to you, is not the most exciting of reading. It'll tell you a little bit of the goals of the company. It'll tell you who the owners are, not so much the owners, but the managers. Sometimes you got to read that with a grain of salt, because basically the managers are telling how great they are. And they'll certainly tell you what their background is and how smart they are. Newspapers, more online now, obviously. Wall Street Journal. There's always a lot of different publications. Kiplinger is another good one, kind of like Morningstar. Kiplinger has what's known as their 25 favorite no-load mutual funds. That's a good one to take a look at, because no-load fund means that they're not going to charge it any load. They will have the 12B-1 expense, because they've got to make a little bit of money, but the expense ratio will be much lower. So there's a lot of variety, and there's just no reason why you can't do it. Now, let's take a look on 579, because like everything, if you're going to invest in mutual funds and start to invest in the stock market, there is risk. Has anything shown how much risk there can be? It's been the last 7-8 weeks of our life. Okay, top of 579. The advantages, other advantages of purchasing into a mutual fund. One is the ease of buying and selling shares. You can just do it on the telephone or online. You can change the amount you want, very easy to do, the funds that you want to go into. Professional management, I think we've touched on that. Obviously, diversification is great too. We've talked about that quite a bit. Multiple withdrawal options, as I said, is very liquid. You can get your money out very quickly. Again, one thing to note, when you sign up for a mutual fund, when they start to pay dividends, we want to take our dividends not in cash, because cash we have a tendency to spend and we have to pay taxes on it. We want to take it in additional shares. Another advantage, it's real easy to switch privileges between the same fund families. So if you feel like, or your advisor feels like you ought to move some out of this fund, start putting your money in a different fund, it's easy to do within that mutual fund, and there's no charges for that. There are some extra services that they'll have, toll-free phone numbers. Sometimes there's savings and checking accounts. I would say this: we're not going into a mutual fund to open a checking account or a savings account. We're going into a mutual fund to build long-term wealth. But they do offer that. Okay, some of the disadvantages are where there's an upside, there's a downside. Obviously, there is risk. Um, there are withdrawal costs. When you do take money out, generally there will be a fee. There's ongoing management fees, the 12B-1 fee that we've talked about. Sometimes there may be poor performance. They don't always outperform the stock market. And there are potential risks. Some sales personnel are aggressive or unethical, and nobody's perfect. And you know that old saying I talked about, where there's money, there's con men. Where there's roadkill, there's vultures. Same type thing. One thing I would say in my history of investing and observing and looking at it, that is why I like to go, as I say, with the big boys. And the companies that I've listed, that were listed here, are all huge. They're not perfect, and they may from time to time hire unethical people, but if something unethical happens, Merrill Lynch, Vanguard, these type companies aren't going to go away. You'll know where to find them. If you invest in a small company with someone you know, or someone you supposedly know, a friend of a friend, those are the type places that fold up and leave, and they're gone. They're gone to the Bahamas or some other place, and you never see your money again. For me, I would always stick to the real big companies. They've got a great track record, and again, if something happens, we know where to find them. Merrill Lynch can't run and hide in the Bahamas like maybe John's investment company down the street can. Okay, we talked about the return on investment. We want dividends to be paid in additional shares and not in cash. There are taxes on mutual funds, but that's if we sell at a profit and take it as cash. If, just like in the stock market, if we sell some shares in a mutual fund and buy additional shares, we'll be fine and invested. But it's one thing to think about when you do invest, and let's say we reach a goal of a second home, a down payment on a home, a vacation, you take the money out, it will be taxed as ordinary income. So you kind of have to take that into consideration. We talked about purchase options. I think the easiest way, again, for a mutual fund is just set it up as an automatic withdrawal from your checking account. The best way would be to set it up like your 401k, quite frankly, where it just comes out of your paycheck, because again, it's so easy just to build your budget around your take-home pay. But very few employers offer that, where they're going to work with a separate mutual fund, and you're doing this over and above your 401k. So I haven't found any. There may be some out there. So for me, again, what I do is through my checking account or my bank account, they take out X amount of dollars on the 20th of each month. And again, if I know that money's coming out, somehow I'll make sure I have the money in there. The withdrawal options, again, are real easy. You just call, or you can email and say, I want to take X amount out. Again, if you take it as cash, it's very liquid. You will have to pay taxes on it. If you transfer it between funds, there's no taxes on that, and you can just talk to the people at the mutual fund, and that will work out just great. On page 560 or 84, at the end of this particular chapter, it talks about your situation, the steps you need to do. I want to just talk, as we kind of wrap up mutual funds this afternoon, or when you listen to this lecture. Mutual funds are great. They are the way that you, as a young investor and someone without a lot of money, quite frankly, can start to access the stock market. I told you that's how my wife and I started 30-some years ago. And quite frankly, back then, I didn't know what a mutual fund was. There weren't many of them. Now there's a lot of variety and a lot of options. But I would just encourage you to get in. Now, your 5-point assignment for today, if you'll email this to me. is again on mutual funds. And you might remember this is a little bit like one we had before. I asked you when we first started to talk about stocks, and this was when we were having class, and this was really before all the chaos that has hit our world came. And I said, how much can each of you invest? And, we had somewhere, some as low as 25, some up to 3, 4, 500 a month. Now, I told you that I would kind of suspend the mutual fund assignment. Actually, I didn't suspend it because everybody gets 20 points for that. But you don't have to open up a mutual fund. But what I would like you to do is tell me by the end of the year, and let's just assume that we're kind of through the coronavirus. I think we'll come out of it slow but sure. It's not, again, I think it's just not going to like turning the light on in a dark room and then all of a sudden everything's wonderful. But I would like each of you to tell me by the end of the year how much a month you think that you can start to invest in a mutual fund, 25, 30, whatever it is. Because again, I just would love to see all of you start to invest in mutual funds. I promise you, as I've said before, if you start doing it, you'll never regret it. The returns will be good. Now, they might be a little shaky at first because as we come out of this coronavirus, but I'll tell you, the old saying of buy low, then sell high. The stock market's down. Drop another 500 points today. It'll probably drop some more. It'll have some ups and downs. But eventually, we're going to get through the coronavirus, and our economy is going to come back. I remember from 2007 to about 2011 or so, when we had the housing bubble and some other problems, the stock market lost a lot of value. A lot of people say get out of the stock market, but it came back. I've seen a lot of the ups and downs in the stock market since I've been investing in the 80s, probably 2 or 3. This is probably the third or fourth real downturn that I've seen in the stock market. It has always come back. And this has been doing it for over 125 years. As I mentioned, we've had, if you look at it, 2 world wars, we had the Dust Bowl, we had the Great Depression, we had the Arab oil embargo, and we've had a couple other downturns, the housing bubble, and now we've got the coronavirus. We'll get through this, and the stock market will come back. All of you are young. All of you got bright futures. You work for a great company. You've got a lot of years to invest. Again, our investment program that we're setting up is long term. So I would really encourage you to look at this and actually try to do it as soon as you can. I realize that with this downturn in the economy, there may be some personal situations where you can't do it now. But I would like each of you, and I'm not going to hold you to it. At the end of the year, the semester will be over, and you'll be long past me. But I would like you again, for your 5-point assignment, is how much do you think you'll be able to set up a mutual fund by the end of the year, and how much can you invest a month? Let's just go over a couple particulars. Let's say it's $50 a month. That's $600 a year. 50 times 12 is 600. In 5 years, that's $3,000 plus the dividends and hopefully the increase in price. 20 a month, not that much. $240 a year in 5 years. That's about $1,000, $1,200. And again, let's think about that 20 a month. What if we don't invest the 20 a month? Again, what are we going to do with it? Let's not kid ourselves. We're going to spend it. And I don't like the word blow it because we'll spend it on something that'll have some value. We'll go out to eat or something like that. But it's not going to have some lasting value, some long-term investment value to it. And, if we don't have that $20, we'll still be able to go out to eat. We might eat a little less or go to a different option. But I would really encourage you to get in and invest. Again, I've been teaching this class a long time. I know a lot of people have invested. I've yet to find one person say, Robert, I wished I hadn't invested. I've wasted all this money, even with ups and downs in the market. Everyone who invests does well. We'll go back to Ann Scheiber. And again, we're not suggesting anyone become a recluse like her. But she noticed this one common element of wealthy people as she reviewed tax returns in her job with the IRS, which started during the Great Depression, okay? The one common element of people that accumulated a lot of wealth and did very well, they all invested in the stock market. There were no mutual funds back then. They just invested in common stocks. Mutual funds is how you can access the stock market. So I would encourage all of you to do that ASAP. Make it a priority as quickly as you can. If you can't do it now, when basically we get through the coronavirus and we kind of get on more of a level footing, we come into what everybody's calling what the new normal is going to be. I can't forecast what that's going to be, but let's take advantage and start to invest. You will never regret it. This is a long-term program that will long outlast the coronavirus and anything else that comes down the pike. Okay, let's review where we're at and where we're going. Okay, we're going toward the end of the semester. I'm going to send you an email this weekend after this week. Hopefully all of you get this assignment. The assignment today for 5 points is how much will you invest in a mutual fund by the end of the year. You're working on your budget. You're working on your investment assignment, term paper, book reports coming. Some of you still need to do the Susie Orman video and let me know you've looked at it. And then we have the 3 articles. Some of you have not done that. If you're missing any other assignments, I have sent you an email and will continue to do that. So I wish all of you well. I hope everyone's doing well. Be cautious. Do what we're told for as far as social distancing, staying home as much as we can, even though it's not always the funnest thing to do. And we'll get through this. Also, do what you're told at work. I'm sure that Discover, as great a company and large as they are, like the company I work for, has our best interest in mind, and they consult their medical professionals and people like that. So any and all advice you get from the wonderful people there at Discover, they're sharp people. I'm very impressed. So make sure you stay on board with them. If you have any questions, you know where I'm at, 801-910-8499. So I appreciate your emails and communication. I wish everyone a great week, and we'll look forward to doing this a week from today. Thank you very much.